Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today our guest is Nathan Cloud. Thanks for being on the show, Nathan.
Having me, Whitney. I'm really looking forward to it.
Nathan worked on Wall Street as a senior equity trader for a proprietary trading firm, managing multiple portfolios and strategies. Since inception in 2019, Cloud Capital has sourced and closed $24 million in multifamily assets. And their newsletter is read by over 1,000 investors every month. Well, Nathan, welcome to the show. It's a pleasure to meet you and just share you being willing to share your expertise. I'm grateful for that. Give us a little more about who you are and coming from Wall Street and into Cloud Capital, and maybe a little bit about that transition. And let's dive into your superpower.
Yeah, sure. Well, first of all, Whitney, I've been following your podcast for about a year now, and I really appreciate you having me on. I think you provide a ton of value out there, specifically diving deep into so many different facets, of this business. So thank you for adding the value that you do. Excited to be here. So the background, accounting background, went to school, interned for Big Four. Honestly, I just wasn't passionate about accounting. It just was not my route, in life. What I always wanted to do is just work on Wall Street. So after school, after accounting, went up there for 6 years where I worked for, it was a family office type structure where our founder was a really successful gentleman. And so we managed his money. And so there were several different strategies that we used. Me personally, I ran 6 different strategies, from algorithms to discretionary strategies, short-term to all the way to, a multi-week period. So it was very short-term trading in nature, where we were trying to return, 15 to 20% a month, and not just like a passive investing strategy. So one thing that was so incredible about, coming out of school in your 20s and then really learning, how to manage risk. I mean, if you want a dose in humility, it's losing thousands of dollars, when you're out of school, 23, 24, 25. There'd be some days where, we'd lose 20 or 30K. And, walking home, you're thinking, wow, it really makes you appreciate risk and money. And that's really what's transitioned also into, Cloud Capital and how we approach risk too. I remember there was one time that one day market closed, went to the restroom, came back, and I was down over 6 figures. And that was a huge shot in the gut. That was a pretty significant loss for myself. There was a few other people that are on the wrong side of this trade, but I remember, after trying to wiggle myself out of that trade, a multiple 6-figure loss, and I was walking back through Times Square, and I remember I saw a trash can. I just couldn't hold it anymore. I threw up into the trash can in Times Square, and I was thinking, what did I do? Like, what lesson was I learning? Was it a black swan event, or was there an error in judgment? So, earlier in my career, it just really set the stage and the foundation to just have that appropriate amount of healthy respect for risk, humility. And then kind of, I guess, how that transitioned into real estate is I was having drinks with this investment banker one day in the financial district, and he started talking about how he and his buddies were buying multifamily. And this was the first time that I heard about it, right? You always hear about the Forbes 500. They always own, 85 or 90% of them own real estate. And so the more we started to talk, he said, yeah, me and my buddies, we buy 50 units, 80 units, 100 units when we can. And these are the type of returns we're generating. So that really started to spin the wheels to multifamily. And then I guess 3 or 4 years later than that, did the first deal myself.
Nice. All right. Yeah, that would, 6 figures coming back that quick and noticing that much, being down that much. I'd be headed right back to the bathroom myself. That's horrible. That's horrible. But you learned a lot. You learned a lot, and you definitely learned a lot about risk and breaking those risks down and having a better understanding, and no doubt about it. So I want to jump right in because in your superpower, and you mentioned before we started recording, just your team's superpower is really underwriting and breaking down the risks, like you're talking about. And so I'd love to dive into that a little bit. And you help us think about deals, how you all think about them, and understanding the risks, in a very understandable manner, even ways to express them to investors as well. But help us get started a little bit on your process of underwriting and breaking those risks down.
Yeah, sure. So I think that knowing how to, and there's not really a right or wrong way, and how each sponsor, capital raiser, operator, et cetera, breaks down a deal and how they evaluate it. I think the main thing is, one, that you're always learning, but two, that you have a process that you're basically going through to say, hey, what are the characteristics of a good deal for us and our equity and our targeted returns? And then how can you repeat that process? Because just like you, we looked at 520 deals, forgotten, 520 or 540 in 2019 across 6 different states. So we were underwriting in Texas, in Phoenix, in Florida, in Georgia, in the Carolinas. And so there's just start to be similarities that come across in these deals that you can notice as well and say, wow, there's something different about this deal, or that this deal underwrites and it seems too good to be true. All of a sudden I have a 16.5, 17 IRR. This should probably be around a 15 to 14.5. There's something in my assumptions that's not incorrect. So let's kind of start from the top. We get the broker OM, right? Or a broker approaches us about an off-market deal. We can talk about off-market deals versus on-market deals for an entire podcast. There's many lines of thought.
Sure.
So we get the broker OM. Okay, it starts with the market first. There's nothing fancy than what we do. Everybody's doing the same exact thing with employment growth, population drivers, et cetera. So our target markets are Austin, Dallas, Atlanta, and a few secondary markets in those areas. So we're looking at the same target markets that most people are looking at that are really demanding those key demand drivers. Then we're going to jump into the sub-market, right? Initially, we get that. We're looking at median incomes. Are they 40 to 45, 50? Are they lower than 30K? Like our risk right there, median incomes is, let's say it's a great value add deal, but it's in a lower socioeconomic area, right? With median incomes of 33,000. We know just inherently, even though there's a $150 rent bump that could be achieved or that the broker's promoting, can our tenant base really afford that rent bump? The answer is probably not, right? We can probably only pro forma those rents at 50% of what we think might be achievable just in order to remain conservative. Because, as you know, the best deal is typically underwriting the hood. Then we're going to go into crime ratings. What's the crime rating? That also plays into the median income. Proximity to interstates. Are we, 3 to 5 minutes from the nearest highways or interstates where it's really easy to get to work? School ratings. There's a lot of 3 bedrooms as opposed to 1s. Families typically tend to migrate to these apartment buildings, right? So how close are we to the great schools? Supply demand imbalances, right? Everybody talks about new construction, but I think there's different ways of thinking about new construction. So let's say that it's a poor submarket. Say median income is around 38 to 42 grand. Let's say that a new development is happening a mile away from our deal, right? By really a top tier developer in the city. We're not going to be catering to the same tenants. So that gives me a lot of confidence that this area could be growing. Whereas if we're in a great submarket, 75K median incomes, and then there's also 2 new deals with 2 new high profile developers, I see that as risk in a really high submarket. So that's the submarket. Then breaking down into the deal, the current owner, is he sophisticated? Is he out of state? Is he self-managing the deal? Who's his property manager? Do we know them? Chances are we do. If we don't, that could be an additional layer of opportunity for us to jump in. What type of debt does he have on this deal? How many times has this property traded this cycle? Has it traded twice? Has it traded none? Or has it traded 3 or 4 times like most of these deals in DFW, where all the value add just sucked out of these deals, and it's basically being traded to the same guru group, over and over again. We just don't have a big competitive advantage in that. So that's just high level what we're thinking about before we even model the deal out.
Nice. No, that's awesome. That's some, yeah, I mean, you just laid out so many things there that I know that, it's just great reminders, great hearing those things again. What's a good place you're finding a lot of this data and information that's helping you analyze, say, the market or sub-market and things like that?
Gosh. So I have a folder. It's basically called Underwriting. And in there we have 5 or 6 different websites that have to do with crime. We have Google Maps. What we do is I paid a VA to essentially go in there and outline every single sub-market along with median incomes and growth rates, et cetera. So I can just pull up Google Maps and there's like a custom feature where you can have different layers. So we're layering in median incomes, crime, new developments, path of progresses, Chick-fil-A, Starbucks, Home Depots, Lowe's, et cetera. So you can find all this information for free, essentially, but we just, I guess, take it a different step in a different direction and then layer all that data into Google Maps. And then, we just follow the CoStars, Real Capital Analytics, and then Yardi. But those are a bit more costly.
That path of progress or growth, like you're talking about, is there a place where you find that, like where the Chick-fil-A's are coming in and things like that?
Not at all. What you can do is you can actually go on your Google Map, and in my layer, it's called Path of Progress, and you can just search, or the VA, search for Chick-fil-A, then automatically they all pop up, Starbucks, they all pop up, etc. So, whatever you want to look for. And we typically like to stay away from Dollar Generals.
That's funny. That's funny. So is there a specific underwriting model or template that you like to use, or did you build your own?
So this is, in my opinion, and then we have an analyst that sits in Chicago, talking with a lot of sponsors. This is the most underutilized and underdiscussed, I think, topic in all of multifamily, right? I mean, we all know it's a great asset class. It has tax advantages, depreciation, et cetera. We know that, high level, it's a good asset class. But what really happens when you start to dig down into the details, into the numbers, it's all about how you model the deal out. Because every OM, okay, if we're gonna send out a deal like we did, we're gonna have more or less the same targeted returns, close to 15 IRR, up or down, around a 7.5 to 8.5 cash on cash, and then somewhere around like a 1.75 to 1.9 equity multiple. That's just where the market's trading. But as a passive investor and as another sponsor that's thinking about co-GPing with another group, it's, do I trust the sponsor? One, do I know them? Do they have a good track record? But two, what type of modeling are they using? Are they outsourcing this to a 23 or 24-year-old that works at a REIT or somebody they met on Upwork? Or do they actually go through the grueling 1,000-hour process of creating their own proprietary models? So apologies, that was a really long-winded answer, but it's something I'm really passionate about. We use our own proprietary models, and it helped that I have the background in building models and building algorithms, but I still had to learn real estate and how specifically revenue streams in, revenue streams out, and how to really go through the art of a deal and underwriting it with correct assumptions. So we use our own proprietary model. Also, we'll send it out to anybody. I think it's a shortcut when you go in and you buy somebody's, but also it's just not grounded in reality. Typically, if you're going to go and buy a deal with fancy highlights and inputs, the reality of that deal are going to be far different than what those numbers are actually projecting. But we can talk about that for an hour.
Right. Well, I'd love to know how you, just when underwriting, how you're prepared for a potential downturn or something like COVID, and all that, how you all were prepared for this and what does that look like in your underwriting model? And also, so, as a limited partner or somebody that's listening, when they're looking at these models, of course, you get these from so many different operators, and you see so many different models. What are those key things that you do so you're prepared for that kind of downturn and things we can be looking for?
Really good question. So how are we prepared for it? We weren't, like everybody else. But just like any type of investment, you can go in with a very conservative assumption. And I know that a lot of listeners laughed at me saying that our underwriting is conservative. But there are certain things that you can adjust for that you can always underwrite your deals to. So I just wrote an article on LinkedIn a few days ago, actually, about our underwriting and how it changed in COVID. But a few of the really big things that we're underwriting to change-wise is this. So vacancy, we typically underwrite to a 7%, especially in the first year or two. We might blend that up to 6%, but typically we're remaining constant at 7%, no matter, if our subject property is at 95 or 96% occupied. So vacancy went from 7 to around 10%, 9 to 10% in year one, and then we'll blend that back to 7% over year 3 or 4. Because COVID is going to be a pretty big issue for the next year, maybe 18 months, but after a vaccine or something of that nature, this too will pass. So vacancy, we increased our assumptions. Year one rent growth, we have at 0%. And then year two, we're back at 1.5, and then we blend it out at 2. We're never going to underwrite a deal at 3% rent growth, for perpetuity. That can really skew the numbers. Also, our delinquency is going to go up from around 0.5, 0.8 to about 1.5% that first year. Then it trails off to 1% and then about 0.5 to 0.8 in line with pre-COVID assumptions. But the biggest thing is our terminal exit rate. I mean, a lot of sponsors are talking about they're increasing their terminal exit. I don't think that necessarily would be prudent. If we're going to exit this deal in 5 to 7 years, COVID is not going to be an issue, and we do have a 50 to 70 basis points increase, but it's just not going to be a factor in 5 or 7 years COVID wise.
Talk about the rent growth again a little bit. You said you'll start with 0%, and that's because of COVID, I assume, or you probably, or were you modeling that before COVID? Or is that something that's now we see? Okay, we shouldn't expect any rent growth over the next year, so that's the way we're modeling now.
So that is 2 points to that question. Pre-COVID, we are underwriting to about either a 0 or a 1% rent growth, but also we're doing value add deals. So we're bumping rents from $1, square foot to $1.15 a square foot in the next 16 to 18 months. So there's a huge rent increase bump inherently in that, but we'll sometimes increase our rents 1% with in-place rents, anticipating leases that are going to get renewed. Post-COVID, right now, we're underwriting to 0% rent growth. And then also, if we thought we could achieve a $100 rent bump, we're going to go to $70, $65 just to remain conservative. Because one thing we don't want to do is compound error in the first year or two upon stabilization. Because if you get income wrong in the first 16 to 18 months of your model, it just compounds that error until you sell.
Yeah, some big issues there, right? Or you start from the very beginning in the hole. But so what about reserves? What kind of reserves do you all like to have in place?
So it depends, one, with what the lender is asking us or telling us, I guess we should say, what we need to require, and then two, what we feel comfortable with. So we've been underwriting to 300. We were underwriting about a year and a half ago, 250, but now we're just underwriting 300 for reserves.
So when you say 300, like 300 per door?
Correct.
Yeah. Okay. And then is that anything separate from what the lender might require? Just like an emergency fund or anything like that?
So now, as you're aware, it's changed on the lender's end with what they're requiring. Sure. In April and in March, it made it really difficult to do a deal because the lenders right. and the agencies, even though they stayed high on their percentage change, on that leverage at 75%, they still said, look, you're going to have 12 months, and if the loan's $6 million and below, 18 months. So 12 months of P&I, reserves, interest, and taxes, which made it extremely difficult to deal. And that's why you didn't see hardly any deals hit the market for about a 2.5 month period. And so the agencies just came out and said, we're just going to require that 12 months, in some cases 9, of just P&I. And so we don't have to raise that additional, 15% of equity that's going to retire, even though it drops off right after you achieve like a 125 or a 135 DSCR for a year. Even though it drops off and you can turn that capital back, I mean, it just makes it a whole heck of a lot different and difficult to raise, an additional 15 or 20% of equity from your passives.
Yeah. Okay. So, in your underwriting process, what are a couple other risks that you might see, and even in reviewing other people's deals or things like that, that is a red flag? So red flags, and then a few errors that I see are kind of different questions, I think, but we'll start from the rent roll. So one,
don't know if I'd necessarily trust the pro forma and the rents that are on the OM that the broker is receiving. You can either input that into your model, or you can have like a formulaic equation, just like a Red IQ, or there's 2 or 3 other softwares that do it. So in our model, we have a specific tab that's devoted to the rent roll. And so we input the rent roll, then it automatically spits out every single floor plan, all the effective rents, concessions, et cetera, and breaks everything down categorically. So I can look and see exactly what's on the rent roll for last month, and there might be a variation with what the OM is showing or what we've been represented by the broker or anyone else. So and as you know, income drives these returns, right? We can manage our expenses, but income's what driving these returns. So it is going to be a huge differentiator if my effective in-place rents are, let's say, 92 cents as opposed to 94, 95 cents with what different material is supporting. So getting the actual correct rents in the rent roll is extremely important. Across the T12, 10 or 15% of the deals, you need to go and check their math with the addition and subtraction. The NOI is incorrect, or the expenses are overstated. So what we do is we have another model, or another tab, in the model that we throw in the T12, and then I put every single line item with a formula to my specific chart of accounts. Then I also have an error check, so I can check their income, I can check their expenses, and check their NOI. And again, 10 or 15% of the time, there's going to be a variance in that. And so that's going to be a question for the broker.
Wow. So, I would, I want to change gears just a little bit, and because, you mentioned, or I know in your bio, it said like your newsletter is read by over 1,000 investors every month. And there's probably a lot of listeners that dream of having a list of that many investors. Right. So I'd love for you to highlight a little bit on your steps to gaining an investor list of that size. I know that's a whole nother conversation. We could probably do a whole show just on that, and that would be great. But maybe you can highlight just a few things, because I know that probably caught a lot of their attention. It did mine, and would love to you to just elaborate a little bit on that.
Sure. Well, first of all, we are a very small firm, and I think you are overstating us. One, you've done a lot more deals than I have, right? You have a wider investor base, and there's a lot of difference in people that actually subscribe or read your newsletter as opposed to people that will actually invest in your deal, right? As
Sure.
you know, it's completely different.
Sure.
So a few of the steps that we took to really grow that base out is utilize some virtual assistants. And what they will do is they'll go into, and we use LinkedIn Sales Navigator. And a lot of people are doing this exact thing. We're not doing anything revolutionary at all, right? We're going in, we are trying to target our investor avatar of somewhat accredited investors, connecting with them across LinkedIn. Don't sell anything, don't pitch anything. That typically doesn't work. And we track data and stats and all this stuff in Google Sheets. But you just connect with them over time when you're putting out content on LinkedIn, et cetera. Maybe shoot them an email that's not salesy at all. They know about multifamily for the most part, right? And this has really blown up in the last 5 years or so with everybody is becoming a syndicator. I actually searched on LinkedIn for people with syndicator in the title, and it was like 9,000. So, they're getting inundated with this information. So don't sell. You'll let the brand kind of speak for itself, and the articles that you publish in your website, your team, et cetera. And then slowly but surely, and we've been doing this for over a year. So, 1,000 seems like a lot, but one, those aren't actual investors. Not everybody's going to invest in the deal. Even if they want to, it might not be a good fit for them, right? But we have been hammering this out for over a year to grow that base. So it's really, I guess, probably not that impressive considering it's taken us over a year.
Well, that's pretty impressive. I know there's listeners, like I said, who are dreaming of having a list that size. I guess, tell me a little about that process before we have to move to a few final questions. So you use LinkedIn Sales Navigator. That's probably something a lot of listeners haven't heard of before. I've briefly heard of it. I've never used it personally. So what does that do for you? And then, what is that follow-up process a little bit, with somebody that you connect, with through LinkedIn?
Yeah, sure. So telling all my secrets here. So you go to LinkedIn Sales Navigator, you can build lists within Navigator, search for certain titles, et cetera. And then you can connect with these individuals. So that's like the first step of the funnel, right? And so you need to connect with them. Then two, you might wait a week or 2 weeks or 3 weeks, et cetera. Then you might shoot them a brief follow-up email. And then if there is interest, they say, hey, look, Whitney would love to jump on a quick call with you, or engage with some of your content. Let me look at the investor presentation. Let me cruise through the website, read a few articles. I'm interested, and they sign up in the newsletter. So, but that process takes 2 months, 2 to 3 months. In fact, for the first time you connect, they might sign up for the newsletter. But again, we are extremely active. Everything's about the process, right? And how you deconstruct a deal. Growing your investor list, it's a process too. It's daily. Every day at 7 a.m., we're working on this till 8:30 in the morning, trying to grow this list and really get our message out. So it doesn't come over time. I created a system. Yeah. Just like anything, I wish it was easier, right? I wish getting the deal was easier. I wish off-market deals came to me more than they do. Wish we had more assets under management, but it's just a process and it takes time.
If it was easy, everyone would do it. And so you reach out to those people. Is that something that, say, virtual assistants can handle quite a bit for you?
Yes, no. So one, I think they're great at the data entry, and just like everything, It takes time to find a really good team and to find a really good VA. So I think they're incredible at the data entry aspect. In terms of the messaging, et cetera, and customizing it, it's just better coming from you. So again, It's just every single day for an hour and a half to 2 hours, I'm having calls, discussions, emails, LinkedIn messages, et cetera. But I'm not selling, you just can't sell in this business, especially when you're asking somebody for 50 or 100K. They can make that judgment of their own.
Right. So what's a way you've improved your business recently that we could apply to ours?
So one thing that we did about a month and a half ago, which was honestly way too late. I wish I would have watched your show and somebody would have pointed this out, but an investor portal. An investor portal, I think, is absolutely crucial. In your business, just some ease of use and streamline, et cetera. So you don't have to have a million Google Docs formulas or folders, right? So adding an investor platform or portal was actually a great step for the business.
What's your best source for meeting new investors right now?
LinkedIn. It would honestly be LinkedIn. And also my marketing guy is just really good. His name's Trevor. You should look him up. He's been incredible in this process. I'm not a marketing guy. I do spreadsheets and finance. I'm not marketing at all. Huge weakness, but he's really good at that. And so he's crafted some documents I think are for the brand that are pretty world class with what the budget that we've had so far to work with. And so he's been an instrumental part of the team. And then we're also connecting with foreign investors, and Trevor's built this funnel that connects with foreign investors and then drips them back through.
Wow. Nice. So what's the number one thing that's contributed to your success?
One, I don't know if I can yet to call Cloud Capital a success yet, right? We've only done one deal. We want to be in this game for a long time. I think transparency with our investors is starting to actually build up that investor list, and saying, look, these are the returns that we could promise, but this is actually what the market is trading. And we get the question all the time, well, this guy's saying these returns over here. Well, who would you probably have a little more trust in? Somebody that's promising a 30% premium, or somebody that's coming in and saying, hey, this is where the market is trading. This is how we're going to preserve your capital, et cetera. So probably transparency is really resonate with the investors, but we're a long way from calling our firm a success.
And how do you like to give back?
Honestly, I have not done a good job at that at all, right? That's one of the things that we talked about like a year ago when we were trying to really formulate our mission statement and how we are going to give back. We haven't done a good job about that so far at all. You're blowing it out of the water, with your causes on the back end.
Well, you'll get there, and no doubt about it. And I'm grateful for your time today, Nathan. Grateful for you just being willing to share your expertise and really walking through some underwriting stuff that we need to have, in front of our minds or on the forefront when we're going through a deal analysis and just understanding risk, and even sharing your story about why that's important to you now, is from some stuff you learned very early on. But no doubt, so important. Grateful for your time. Pleasure to meet you. Tell the listeners how they can get in touch with you and learn more about you.
So the website is cloudcapitalllc.com. And then my email is nathan@cloudcapitalllc.com. And so feel free to visit the website if you want to set up a quick call. Always happy to jump on a quick, 10 or 15 minute call with investors, or, just to talk about the state of the real estate market. And Whitney, thank you so much for having me on. I really do appreciate it. You've done a lot of big things with this show, and I think you're just getting started.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.